So right now, the amount of debt service is about $630 billion a year. And the average interest rate on that is 2.8%. Okay, so we know that rates are like 4.8% or up into the fives with the short term. So it's reasonable to assume that given the needs and given the $2 trillion deficit, that the debt service will explode. Indeed, it will in 2024 be the second largest spending category. Right now, again, it's $230 billion a year, and that will definitely go up to probably 900 over the next year. Just the deficit
What,
alone.
$900 billion? That's going to be the interest costs?
Yeah. So right now it's 630.
$1 trillion a year in interest costs? That is insane. Yeah. I mean, exactly. We talk about big numbers, Professor, all the time here, but that's just bonkers. I mean, didn't like Treasury understand what was happening? Why, when we were at zero, why didn't they just put out 100-year bonds like the Austrians?
Well, I advocated that. Take advantage of these super low rates. And obviously, when you do that, the rates go up. But still, it was not normal to have 1% rate on a 10-year Treasury, given what inflation was.
We hit 1% on the 30-year in 2020.
Yeah. So again, you could argue you should take advantage of that. But look, the problem is a structural problem. So when we have reasonably good growth and a $2 trillion deficit, that's a big problem. And again, so the 630 is carefully calculated. So, for example, we need to be careful with the Fed balance sheet and stuff like that, which is kind of left pocket to right pocket for the government. But if you carefully calculate it, it's about $630 billion, and that's at 2.8%. It's reasonable to expect that rate will go up. And when it goes up, it'll be the second largest spending category, just paying interest. That is not a good situation.
Yep.
And especially if we have slower growth. So we had a great print, and this is kind of consumers running down their savings. And if you look at kind of the leading data, you can see that those savings are pretty well depleted. The consumer is not going to bail out the economy in 2024 like it did in 2023.
Hey, Cam, when we hear from the Fed Chairman Jay Powell this afternoon, he's probably going to come out with the language that, as it relates to inflation, we have a long way to go to defeat inflation. Do you buy that?
No. And we've talked about this before. So if you calculate the inflation rate with kind of real-time prices for housing and rents, the inflation rate is below 2%.
Really?
The only reason it's above 3 is we've got the lagged effect from rental and housing inflation that happened last year. So in real time, we're below 2%. I have no idea what they're talking about. And making policy based upon data from last year, that doesn't make any sense. You make policy based upon data today and what you anticipate will happen in the future.
Isn't it frustrating to watch this happen? I mean, if you advocated for, longer term debt when we were at zero interest rate policy, I can't imagine who would push back against that. Why would the Treasury Secretary not do that? And then if you think the Fed is using, clearly bad data in order to drive policy, that should, I imagine, annoy you too. Like, is it difficult to move around in this world?
Yeah, I think annoying is the right word. This is not rocket science. You just look at the data. It's very clear what's happening, especially with the housing inflation. So the housing inflation, if you believe the CPI, is running at a rate over 7% year over year. And that just doesn't square with the data. It doesn't square with year-over-year rents. It doesn't square with year-over-year housing prices. It's because it's reflecting what happened last year. So I think that there is a problem. We need to use data that is real-time data. Housing inflation is not over 7%. And that is the reason most of the print that we get, the prints that have been over 3%, is being driven by stale data on housing. And that just doesn't seem right. And also, we've seen the long rates increase pretty dramatically. And this is kind of flattening the yield curve, but in a very bad way. So usually what happens before kind of recessions, that you get a yield curve inversion where the long rates are below the short rates, but then it becomes normal. And usually what happens is that the short rates decrease to cause the normal yield curve. That's not what we're seeing. We're seeing the long rates go up. That's very bad. That increases the cost of capital, and that serves to slow the economy. So this is not a good situation in any dimension. And Don't be fooled by that GDP print.
Yep. So is the risk here, Professor, that the Fed is overdoing it and will in fact push us into recession?
GDP will fall off a cliff, plus our interest payments are ballooning at a level that's going to make it hard to invest in things like solving diseases and funding the military.
That's not bueno. So is that the recession risk?
Yeah. So the Fed should have stood down in January of this year. So I agree that they've made things worse. And it's especially bad given what we've seen happen to the long-term rate. That ripples through. And just think of, these firms with commercial real estate loans and things like that, where that market is already cratered, and what's going to happen. So we saw kind of a mini banking crisis in March, and then it's hush hush. Well, I'd like to see what's going to happen in the next few months, because we're not going to have 4+ GDP growth. That consumer spending has been depleted. Savings have been drawn down. And on the investment side, we've already seen that decrease in 2023. So I do believe that the Fed has overdone it unnecessarily, shot themselves in the foot and the economy at the same time.